Have you ever just stared at a financial chart, with all its jagged peaks and valleys, and felt like it was trying to tell you something? Like there's a secret language hidden in all those squiggles, a story about what's coming next, if only you knew how to read it. Well, that promise, that idea, that's what we're digging into today.
So let's just get right to it. Can you really predict where the market's headed just by looking at where it's been? Or is it all just random noise? Like a financial ink blot test where we just see whatever patterns we want to see. This is the core question we're going to try and answer. You see, this whole practice of looking for secrets, for clues hidden in the data, it has a name. It's called technical analysis. And it's all built on this one big idea, that a price chart isn't just a random line. Nope, it's a footprint. It's a detailed record of human emotion, of fear, of greed, and everything in between.
And that's technical analysis, or TA for short. Now, the philosophy behind it is actually pretty simple. A technical analyst doesn't really care why someone bought or sold a stock. They're not looking at earnings reports or interviewing the CEO. They only care that the transaction happened. The whole game rests on one crucial assumption, that every bit of news, every opinion, and every emotion out there is already baked into the price you see on your screen.
Okay, but as you can probably guess, this idea is, well, it's pretty controversial. It really sets up this huge intellectual battle that's been raging in the world of finance for decades. On one side, you've got the chartists, the technicians, and on the other, you've got the academics who basically say the market is way too smart for any of that to work. And this slide really lays out the two opposing teams. Technical analysis says history rhymes. It believes that human behavior repeats itself, and because of that, it leaves behind these predictable footprints in the price data. The other side, the efficient markets hypothesis, argues the total opposite. It says the market is so incredibly fast at absorbing new information that by the time you spot some kind of pattern, it's already gone. The past is basically a random walk, like a coin flip, and it gives you zero edge on what's coming next.
So, if you're one of these technical analysts, what are you actually doing all day? What are you looking for? How do you even begin to try and decode this supposed language of the market? Well, it all starts with a few fundamental building blocks.
Okay, the single most important concept, the absolute bedrock of all this, is trend. And it's beautifully simple. Is the market basically building a staircase up, making higher peaks and higher valleys along the way? That's an uptrend. Or is it stepping down with lower peaks and lower valleys? Well, that's a downtrend. Figuring out which way the main current is flowing, that's job number one.
And this brings us to this really cool idea of market memory. Think of support as a historical floor. So let's say a stock has bounced off the $50 mark 3 times over the past year. That $50 level becomes a known area of support, a place where buyers have shown up in the past. And resistance, it's just the opposite, a price ceiling, where historically sellers have come in and taken control. Analysts watch these levels like a hawk for potential turning points.
Now, beyond those basics, analysts have this whole dashboard of tools they use. You've got moving averages, which basically just smooth out all the choppy day-to-day noise so you can see the underlying trend more clearly. Then there are things like the RSI, which try to measure if a market is overbought or oversold in the short term, kind of like a car's engine running too hot. And volume. Oh, volume is critical. It's the conviction behind a price move. A big price jump on really weak volume? That's a huge red flag.
Okay, so that's the theory, and that's the toolkit. But here is the multi-trillion-dollar question. Does any of it actually work? I mean, when you take these ideas and you put them under a microscope with rigorous academic testing, what do you find?
Well, the answer is, it's complicated, but it's really fascinating. It's like this academic tug of war. On the one hand, a really famous study back in '92 found that simple moving average rules did produce returns that were way better than chance, going all the way back to the 1890s. But the skeptics have this killer counterargument. It's called data snooping. Think of it like this. If you try 10,000 random keys on a locked door, you're eventually going to find one that fits just by pure chance. It doesn't mean you're a master locksmith. Data snooping is the same idea. You test so many thousands of rules on past data that you're bound to find some that worked just by dumb luck.
So, where does all this leave us? Is it all just a big coin flip? Well, not exactly. In recent years, a much more modern, more nuanced view has started to take hold. It's one that kind of synthesizes both sides of the debate and tries to move technical analysis away from being this subjective art form and more toward a disciplined science.
And here it is. This is the absolute key takeaway from literally decades of academic research.
while a lot of those really complex, esoteric chart patterns show pretty weak evidence. The simple, core ideas, trend and momentum, have been shown to have real statistical weight across all sorts of different markets and time periods. So it seems the market isn't entirely random after all. It does have some memory, and trends really do seem to last longer than pure chance would suggest.
And that leads to this incredibly important shift in thinking. The goal of modern TA isn't to be a crystal ball. It is not about being right all the time or predicting the exact top or bottom of the market. It's about risk management. It's about figuring out the current market environment and then placing your bets where the probabilities are stacked in your favor.
So what does that actually look like in practice? It looks like a disciplined process. First, you identify the market's regime. Is it trending hard or is it just chopping around sideways? Then, based on that, you use a really simple, robust rule to generate a signal, something like, I'll buy when the price is above its 200-day average, and I'll sell when it's below. And then, most importantly, you manage your risk with ironclad rules for when you get out and how much you're willing to bet. It becomes a system, not a guess.
And look, you don't have to be some hyperactive day trader for any of this to be useful. Even if you're a long-term, passive investor, these concepts can be incredibly powerful. You could use a simple trend rule to help you reduce risk during a major bear market, or you can use rules to help you avoid the biggest behavioral mistakes like panic selling at the bottom or getting way too greedy at the top. It provides a framework. It provides discipline.
Which, of course, brings us all the way back to where we started. Is the market a story we could read, or is it just random, meaningless noise? Well, the modern answer seems to be, it's a little bit of both. It's not some perfectly predictable storybook, that's for sure, but it's not pure noise either. It seems to be a story of probabilities, where learning to read the trends can at least help you manage the risks of a very uncertain future. The real question is, what story are you seeing?